The battle to take over MEG Energy, the oil sands producer with about 100,000 barrels of oil equivalent every day, is pitting a friendly, cash-heavy offer from one of Canada's biggest oil sands players, Cenovus, against a retooled hostile bid from Strathcona Resources that is now all stock. We are joined now by the man himself, Adam Waterous, Executive Chairman of Strathcona Resources. It's great to see you.
Always nice to see you, Andy.
So you're frustrated. You feel that the MEG board, who have been non-committal on your latest offer, but you feel that they're going with Cenovus when it's an inferior deal?
Well, maybe I just, for context for your viewers, what we've done is we've changed our bid to be all stock, which is shareholders of MEG would receive 0.8 of a share of Strathcona for every MEG share that they own. What that will result in is that MEG shareholders will own 43% of Strathcona on a pro forma basis. And why that ends up being really important is that this deal has a huge amount of economic upside. And this will give the opportunity for MEG shareholders to be able to enjoy that. Now, to give you just a perspective on that, we were just talking offline about the M&A business. So it's quite important how the M&A business works.
And you are a former top investment banker, so you know about this. Carry on.
Some experience. So if you look in the last 20 years in Canada, where one public company takes over another public company, there have been 102 of those deals where it's like 500 million or more. And when you look at those transactions, typically the median time, the buyer's shares actually go down about 2%. In this case, what's just happened is in the announcement, this is in the 5 days following an announcement of a transaction. In this case, Cenovus' shares went up 10%. Now, that's only half the story. The second half of the story you have to understand is, now, what is that change in share price relative to the target value? Now, again, 102 transactions the last 20 years in Canada. Typically, the buyer's share price goes down about 5% to the equivalent of what they're buying. In the case of Cenovus acquisition of MEG, the value increased $3.9 billion. That's 56% of the value of the $7 billion market value of that. That's the highest percentage of the 102 transactions in the last 20 years in Canada. Meaning, put another way is, there's been $3.9 billion left on the table by MEG shareholders with this transaction.
It's an interesting number, Adam, but as you know, there's merger arbitrage and there's a lot of factors that move a stock.
No, this is just the immediate five days following the transaction. And this is a big sample set, Andy. 102 transactions. Now, $3.9 billion. Now, why this ends up being super important is, going back to why have we changed our consideration? Well, if you're a MEG shareholder, you say, and that's really only the opportunity to be able to create that value is by being part of a larger SAGD business. Strathcona has a steam assisted gravity drainage business, so does Cenovus. And Cenovus and Strathcona are in violent agreement that they're, by a bigger SAGD business owning MEG, will be able to better exploit the business. And Cenovus has gone in great detail about this. That's in part why the value of the stock went up so much. But here's the trick. Here's the real notion. In the Cenovus proposal, 25% is shares. And so MEG shareholders with Cenovus will end up owning 4% of Cenovus. With us, with Strathcona, they'll own 43% of Strathcona. So in terms of realizing on that $3.9 billion of upside, you get 10 times more with Strathcona than you do with Cenovus.
But you get a pile more cash from Cenovus.
And you get cash, right? Yeah. So what's great is we have a very clear it's your apples and oranges, chalk and cheese, black and white. You want to exit, crystallize your value, sort of get off the train, or you want to actually ride the upside, stay on the train with Strathcona. So these are very radically different paths for shareholders.
Jamie.
So, I think if I was a MEG shareholder and you're saying that there's potentially up to $4 billion left on the table, what I'm hearing is like, well, I want to get more and more of that upside, but maybe not waiting for that to play out over multiple years, like why don't you increase your value or your offer $1 or $2 billion to cut into that $4 billion today?
So we've increased our price.
Yeah.
And right now we're 11% higher than the competing Cenovus alternative.
I haven't managed to do the calculation this morning, but that's what you reckon. It's about 11%.
That was as of Friday. Okay. So
fair enough. Yeah.
But it didn't change much yesterday.
Okay.
On the announcement, our stock was comparatively flat on it, so it hasn't had a really big change.
Sorry, Adam. Go on. Yeah.
But in terms of what's really important to understand about this upside is, and which Cenovus was very clear about, and we've been clear about, it can only be realized by being part of a bigger business, a bigger SAGD business. And this is capital investment opportunities, how to develop the asset better. So MEG can't do this on its own. So the question is, if you've got $3.9 billion in potential value, how do you realize it as a MEG shareholder? Well, you're not going to be able to get it if you just take cash. So it's not like, oh, this one's $1 more or $2 more. The simple math, $3.9 billion, there's 254 million shares outstanding for MEG.
Okay.
That's $15.35. Meaning, to give you you can do the very quick math, the original Cenovus transaction was reported to be $27.25. If they actually just wanted to, if you're doing a cash transaction, they should have paid something like $42.60. I mean, it's an order of magnitude different. So the only chance to be able to realize that value is by taking shares.
Why do you think the MEG board has so far turned its back on you, or certainly not been willing to say we're open to this?
I've been very clear about. We've been keen to engage with the MEG board from day one. But actually, it's a very good question, Andy, because the question's like, how did this $3.9 billion get left on the table? Here's what usually happens. Usually, when an offer is made, a board will go around and try and get a competitive alternative and play off bidders against each other, bid the price up, and they evaporate that $3.9 billion to zero or less. In this case, what MEG's board did is they only had one other bid, being Cenovus. And because they never called us, never engaged with us, never talked to us, they didn't have any competitive tension against Cenovus. So effectively just gifted the company to them on a take-under, meaning when they announced the transaction, their transaction was about $1 less than our offer. It was less than what MEG was trading at the time. Now, why would they do such a thing? Well, sometimes people get grumpy when they are about to lose their job. And that's what, unfortunately, boards have fiduciary duties to not think about their personal situation and think about the benefit of the shareholders. And Strathcona put the company in play by making the offer, and that was only because we had tried to engage constructively, privately with the company, but they rejected any kind of dialogue with us. So we made the company our offer public, putting the company in play, and they're grumpy about that. And the entire time, for 4 months, they have refused to talk to us. So as a result, they gave the company away.
Adam, I'm very sorry. We have to break away. You have just over 14% of MEG Energy, and you've said we're ready to vote against this deal. We don't have time to get into all those numbers, but I hope you can come back soon. I'm very sorry.
Thanks very much.
Adam Waterous, who heads up Strathcona Resources.